So my next guest has been saying that we're actually in two separate stock markets. On one hand, you've got the AI market, which consists of 41 names. On the other hand, non-AI, 459 names. And well, you might be surprised which one is actually outperforming this year. I want to bring in Bianco Research President Jim Bianco. All right, so Jim, on one hand, we got Mag 7, AI utility, AI CapEx, cap equipment rather, and other AI direct. So this morning I'm watching this market. Nvidia's up a little bit. I think Caterpillar might have been up for a minute, but everything that's done extraordinarily well that had AI attached to it is coming down a lot. It kind of reminds me when some companies were back in the day were slapping .com on their name. This isn't the same, is it?
No, it's not. It's not the same. I mean, the AI build out is very real, but you have to look at the way that these two groups are trading. And by the way, they're almost the same size. That 41 AI stocks is about 45% of the size of the stock market. The other 459 names is 55% of the stock market. And they trade opposite each other. Today, as an example, market's down today. But if you look at like the 455 names, the XAI names, those stocks are up almost 1% today. So if the headline is the stock market's down because investors are worried about the economy, well, the real economy stocks like, financials and consumer and industrials, they're actually having a good day today. So we need to start to think about that these two groups in the market are very, very different right now. And that's why I say it's almost like there's two asset classes.
All right, give me 1 second, Jim. We're going to turn your sound on in the studio. We were trying to adjust something while you were talking. I didn't hear the last part of what you said. I'm embarrassed to say that, but I know it was smart and pithy. But we're going to turn the speaker on in the studio so I can hear you. So for investors, right, who are watching this, and I think this Google earnings report is a prime example. It feels like even with the best possible news, these stocks are going down. Should folks be discouraged about that, or is it sort of par for the course?
I think it's par for the course. You're talking about a lot of technology right now that a lot of people are still trying to figure out and understand. We talk about agentic AI, and let's be real, very few people really know what that means. And they get afraid because of all of the spending that's going on. And so technology is always going to be a very volatile type of investment. And the history of technology is it usually ends with a bubble. It usually ends with a massive overspend and too much capacity. I don't think we're there now, but that is the history of where we're probably going to wind up somewhere down in the future, just not immediately.
So if you take the old bubble, right, the tech/telecom bubble, up to 99, the numbers were phenomenal. But from 1999 to early 2001 and 2000 rather, some of these same names went up even higher. It was exponential. Like I can't even describe it. You remember those numbers, and my greatest fear is for a lot of folks who are new to the market or haven't gone through this before, is that they're getting out of some of these names too early.
Yes, I think that would always be the case. Everybody's afraid that the market's going to go down, and you wind up going too far when you think that the market's going to go down. I think if you want to use that 99 to 2000 example, we're more like 1997, 1998 than we are near like the spring of 2000. And, give you one example. In December of 1996, Alan Greenspan famously asked about irrational exuberance. We were worried about the tech bubble back then, and it ran for another 3 years. So yes, if you're going to be an investor in this stuff, recognize it's volatile. It's going to swing around a lot.
Right.
But I still think you want to look for, did we build way, way too much of this? With only 2% of the public right now using AI to any great degree, I don't think we have. There's still a lot more adoption coming.
You brought up Greenspan. 10 years before that moment, he was ushered in as the new FOMC chair. He changed whatever you think of him, he changed the Fed in many ways. Warsh is now trying to put his stamp on it. I don't think there'll be a hike on Wednesday, even September. Nevertheless, though, how do you see Kevin Warsh right now? Because a lot of folks are still trying to interpret who he is.
Two things you need to understand about him. First of all, he doesn't believe in forward guidance. That's a fancy term for just saying, I'm going to tell you what we're going to do right before we do it. That's why, as you pointed out earlier in the show, we have a 38% chance the Fed is going to raise rates at the meeting on Wednesday. We've never seen in 17 years, since the end of the financial crisis, in 17 years, we have not seen that much uncertainty about a rate hike. Usually 2 days before the meeting, we're at like 1% or 99%. Either they're going to move or they're not going to move. And that's because he's not telling us what he wants to do, because he doesn't believe in forward guidance. I happen to agree with him on that. And the other thing is, he's the leader of a committee. He doesn't decide what the policy is going to be anymore. It's the voters of the committee. So even if we don't get a rate hike on Wednesday, I wouldn't be surprised if we get anywhere between 3 and maybe as many as 6 dissents. So it'll be no move, but you're going to see several members say, that would vote for a rate hike this week. Wow. And that's different than what we've seen before. This is a very different Fed, the way that they operate right now.
Wow. So I've heard the term like a hawkish cut or a dovish hike. This would be a hawkish no move. Like, I mean, wow. Well, we'll keep an eye out for it. Jim, man, it's great stuff. I appreciate it. Let's talk again real soon.
Thank you.
It's been far too long. All right, folks.